There's more to practicing medicine than learning medicine. To launch a successful career, you also need to understand the business of business. This course is one of a series offered by Career Physician to provide you with a wide range of valuable skills you need to put you in control of the financial side of your career. Finding the right medical practice once you complete your medical training is one of the most important steps you'll take. And finding the right practice means knowing how to assess that practice's financial condition. You can think of a practice's financial condition as similar to a patient's health condition. It's a point-in-time evaluation with historical context that gives you some predictive ability if things remain the same. This course will introduce you to a number of financial concepts important in determining the financial condition of a medical practice. It'll also teach you how to identify and evaluate key financial information generated from balance sheets, income statements, and various practice management system reports. You'll see what each of these statements and reports looks like and learn how to identify the key information you need from them. We'll explain common financial terms you need to understand. Then, you'll learn various techniques for analyzing this data to get the information you need to make an informed decision as to the financial condition of a particular medical practice. Why is this important? There are several reasons. First, in most settings, the financial condition of the medical practice directly impacts your own income and career satisfaction. Second, your initial impressions may not be accurate. The financial condition of practices varies widely, ranging from excellent to those in serious financial trouble. It pays to know what you're getting into. Third, if your personal financial goals are important to you in joining, buying, or making decisions regarding a practice, then you must learn to understand the factors that contribute to the practice's financial condition. Information you need to begin your analysis is contained in the practice's financial documents, including balance sheets, income statements, aging of accounts receivable reports, and payer mix reports. We'll explain each of these in detail as we go through the course. You may discover that gathering this information is not always easy. Certain practices may consider their financial information to be confidential and proprietary. In order to gain access to these documents, you may need to offer to sign a confidentiality agreement for sole purpose of evaluating an opportunity. In some instances, the unwillingness of a group to share financial information may be a sign of financial problems or other issues the group would rather not disclose. Or it could indicate a general reluctance to share information. It's important to consider this possibility because open communication and sharing of information is critical to the success of a group practice. In other instances, the information you need may simply be unavailable, not meaningful, or only produced on an annual basis. In any particular situation, you'll need to judge whether you have adequate information to make a useful assessment of a practice's financial condition. Once you've completed your analysis, you'll also need to do a reality check. This is called benchmarking. Compare your own findings with data on comparable practices. National practice management organizations, such as the Medical Group Management Association, offer benchmark cost and productivity data organized by specialty and practice setting. The two most important financial statements you need to understand are balance sheets and income statements. Let's look at each of these in turn to get an idea of what information they include and why that data is important to you. This is what a typical balance sheet looks like. The key information you can gather from it is a detailed tally of the assets and the liabilities of the practice, essentially what they have and what they owe. Both assets and liabilities are subdivided into several categories. We'll define each of these and explain how they contribute to the overall picture. Assets are defined as anything of value owned by the practice. This includes cash, furnishings, equipment, and accounts receivable, or amounts due the practice from patients and insurers for services the practice has already provided. Assets are generally grouped into three categories: current, long-term, and fixed. Current assets include cash and accounts receivable, payments expected from patients and insurance companies within a year. Long-term assets reflect long-term investments in financial assets, with maturities exceeding a year. For example, a 5-year certificate of deposit. Fixed assets include real property and equipment, including office furniture, fixtures and equipment, medical equipment, and other tangible items owned by the practice. If the group is well established, most of these fixed assets will be almost completely depreciated. Depreciation is an accounting method that recognizes the useful life of assets. A common method for calculating depreciation is straight-line depreciation. For example, a computer purchased last year for $1,500 with a useful life of 3 years is depreciated at $500 per year. Liabilities are amounts that are owed by the practice. Current liabilities are those expected to be due within a year. One example of a current liability is accounts payable, or money owed by the practice for products or services it has already received but not yet paid for. Long-term liabilities are those due over a period greater than 1 year, such as an installment bank loan to cover the purchases of major medical equipment. Another important item you'll see on a balance sheet is stockholders' equity. Stockholders' equity is the difference between assets and liabilities and consists of contributed capital and retained earnings. Contributed capital is the amount of money invested in the practice by a shareholder to fund its capital requirements. This would occur at the startup or any time that retained earnings are insufficient to meet the ongoing capital requirements of the practice. Retained earnings are profits previously earned and left in the practice corporation for its future needs. Few practices retain earnings. So, the balance sheet provides information about the assets and liabilities of the group. Think of it as a snapshot of the financial position of a practice at a specific point in time. In reality, of course, the group's finances are always in a state of flux. Money is coming in and going out, investments are made in equipment, lines of credit are accessed, and so on. However, once you learn to read a balance sheet, you can then compare it with balance sheets made at other points in time, or compare it with benchmark data and start to understand not only where a practice is currently positioned financially, but where it's likely to go over a given period of time. Information included on the balance sheet should give you a good understanding of the investments that have been made in the practice and the debts that must be paid. It's important to know whether the group is borrowing to invest in the group's growth or borrowing to maintain a level of physician compensation that may not be warranted based on the group's profitability. If the group is drawing on its credit lines, ask for what those funds have been used and whose responsibility it is to repay the loans. If you're considering becoming a shareholder in a practice, you need to know what, if any, existing debt you'll be assuming. Once you're familiar with the components of a balance sheet, you need to learn how to extract the useful information. Ratio analysis is one of the most useful tools for doing this. We'll cover the two most widely used types of ratio analysis, current ratio and debt-to-equity ratio, and explain why this information is important to you. Current ratio equals current assets divided by current liabilities. The current ratio is useful in assessing the potential for a practice to have short-term financial problems because it compares a practice's current assets to its current liabilities. In our sample balance sheet, you can determine the current ratio for 2002 by selecting the total current assets, $170,000, and the total current liabilities, $40,000. When you divide the total current assets by the total current liabilities, you get a result, or current ratio, of 4.25. This is good news. Generally speaking, a ratio greater than 1 indicates that the group has sufficient cushion to meet its short-term financial obligations. A current ratio lower than 1 could be an indication of short-term difficulty in meeting financial obligations. Debt-to-equity ratio equals long-term debt divided by stockholders' equity. The debt-to-equity ratio compares the financial structure of a group and the manner in which its assets are financed. In our sample balance sheet, you can determine the debt-to-equity for 2003 by selecting the long-term debt, $30,000, and the stockholders' equity, $200,000. When you divide the long-term debt by the stockholders' equity, you get a result, or debt-to-equity ratio, of 0.15. Using an average debt capacity of 50% of total assets, the practice has a debt capacity of $135,000 in 2003. With $30,000 debt outstanding, the practice has $105,000 in additional debt capacity. It's also important to understand that some standard or benchmark is necessary for ratio analysis to be truly informative. Be sure that you use a standard or benchmark that's specific to the specialty or practice type you're researching, such as the size, whether it's a single or multi-specialty practice, whether it's private or academic, and so on. Specialty-specific benchmark data is published by a number of professional associations. In addition to the balance sheet, the other crucial financial statement you need to understand is the income statement. Let's look at a sample income statement to get an idea of what information it includes and why that data is important to you. The income statement is a summary of the revenues and expenses of the practice over a specific time period. In this example, we have the data for 2 full calendar years, 2002 and 2003. We'll explain each of the key components of the income statement in more detail. Gross charges reflect the total amount billed out by the practice at the standard fee schedule rate. This includes amounts billed out to patients and to insurance companies. Contractual allowances are adjustments or discounts made to the gross charges to reflect contractual agreements with insurance companies and other payers regarding the amount to be paid for a particular service. Practices often have agreements with various insurance companies to accept a lesser amount as payment in full for certain services they provide. Net revenues reflect the total services billed or collected by the practice for a given period of time after any adjustments, such as contractual allowances, have been made. Expenses include a number of items, like salaries, benefits, rent, drugs and medical supplies, purchased services such as insurance, accounting or legal services, general and administrative expenses and depreciation, and reflect costs incurred by the practice for a given period of time. Total operating expenses reflects the sum of the expenses required for the operation of the office. Net income is the difference between net revenue and total operating expenses. In this example, for the year 2002, the group's net revenue was $1 million and its total operating expenses were $565,000. This means that the group's net income is equal to $435,000. As you're evaluating the financial condition of a practice, net income is important because it generally reflects the amount available for physician income. As with the balance sheet, simply recognizing all the components of an income statement isn't enough to give you useful information. The 2 most widely used methods of analysis are the operating margin ratio and the accounts receivable turnover ratio. We'll look at each of these in turn and explain why they can tell you about the financial condition of a practice. Operating margin ratio equals net income divided by net revenue. The operating margin ratio is a measure of performance and is used to evaluate the way in which the practice uses its own assets. Let's compare the operating margin ratio for the 2 years that are shown in our sample income statement. In 2002, the net income was $435,000 and the net revenue was $1 million. This results in an operating margin ratio of 43.5%. In 2003, the net income was $640,000 and the net revenue was $1,500,000. This results in an operating margin ratio of 42.6%. As you can see from this example, even though net income and net revenue went up in 2003, the operating margin ratio decreased because expenses grew more than revenues. Once you've determined a practice's operating margin ratio, you'll also need to compare it to the ratios of comparable practices. Operating margin ratios by specialty and type of practice are frequently published by professional associations. Turnover ratios use data from both the balance sheet and the income statement to assess efficiency in the use of the practice's assets. One of the most widely used turnover ratios is the accounts receivable turnover ratio, which calculates the average collection period. Accounts receivable turnover equals net patient revenue divided by net accounts receivable. For example, in 2003, the accounts receivable turnover ratio was $1,500,000 divided by $170,000 equals 8.82. The next step is to determine the average collection period, or the length of time it takes on average for the practice to collect money that it's owed. The average collection period, or ACP, equals 365 days divided by the accounts receivable turnover ratio. In our example from 2003, we see that 365 days divided by 8.82 equals an average collection period of 41.4 days. This means that, on average, it takes the practice 41 days to collect payment for its services. It's common for well-run practices to have an ACP in the range of 40 to 60. Conducting ratio analysis without using comparative data will only give you limited information about the financial condition of a practice. To conduct a thorough comparative analysis, you need access to standard or benchmark data in order to interpret your own findings. However, comparative data may not always be available or may not be meaningful given the unique circumstances of a practice. Another useful method of analysis is called trend analysis. Trend analysis focuses on the trend of a single ratio in the practice over time. It's very useful in assessing whether a specific measure of financial condition in the practice is improving or worsening. For example, the average collection period for 2003 in our income statement was calculated to be 41.4 days. What is the trend relative to the previous year? In 2002, the accounts receivable turnover ratio was 1 million divided by 150,000, which equals 6.67. To calculate the average collection period, we divide 365 days by 6.67. In 2002, the average collection period was 54.7 days. This 2-year trend analysis shows that the practice has achieved a 24% improvement in its average collection period by reducing it from 54.7 days to 41.4 days over the course of 1 year. By comparing the various ratios over a longer period of time, you can begin to develop a sense of how the practice functions financially and what you can reasonably expect to happen if you decide to join that practice. Once you're familiar with balance sheets and income statements, you'll quickly realize that these numbers don't just exist in a vacuum. They're driven by the overall way in which the practice is managed. The information you need to analyze the practice's operation is contained in a number of documents called Practice Management System Reports. We'll take a look at 2 of the most important, the Aging of Account Receivable Report and the Payer Mix Report, and explain what they can tell you about how a practice is managed and what it means to you. The Aging of Accounts Receivable Report can give you insight into the way a practice is managed. Accounts receivable, AR, refers to the money owed to the practice by various debtors, such as insurance companies and patients. It's important to know how well the group performs in collecting these payments due for its services. You can do this by calculating the net collection ratio, which measures how well the group is doing collecting amounts due after contractual adjustments have been made. For example, if billed charges are 4 million and contractual adjustments are 1,200,000, then expected net collections at 100% would be 2,800,000. Anything less would reflect on the performance of AR management. If collections are actually 2 million, then the net collection ratio in this example is around 71%, 2 million divided by 2,800,000. Groups managing AR well have net collection ratios above 95%. You should also determine how many months of revenues are outstanding. For example, if net revenues average 300,000 per month and outstanding AR is 900,000, then 3 months of revenues are outstanding, which is not unusual. If less than 3 months of revenues are outstanding, the group is doing a good job of collecting. If more than 3 months of revenues are outstanding, the practice may need to focus more effort on AR management or evaluate its write-off policy. A write-off policy provides management guidelines concerning when amounts on an account should be considered uncollectible and written off or deducted from outstanding AR. Determine the write-off policy of the group when evaluating AR, particularly for amounts that are greater than 90 days old. The other practice management system report we'll look at is the Payer Mix Report, which lists the payments to the practice by payer type or payer category. For example, the report may summarize payments by categories such as private pay, Medicare, Medicaid, PPO, HMO, etc. Most practices have reports that list out each unique payer. Useful assessments of the payer report are to determine and rank the top payer categories by gross charges billed, top payer categories by payments, and top payer categories by contractual adjustments. These reports provide insight into the group's participation in major health plans and the relative importance of each to the group in terms of revenues. Since some payer types lead to significantly higher contractual allowances and slower payment for services, this report can assist in determining the underlying drivers of contractual adjustments and aging of accounts receivable. In order to assess the financial condition of a medical practice effectively, you must understand not only how to find the key information from the balance sheet, income statement, and practice management reports, but also how to analyze that data to get the information you need. This information is critical to understanding and making decisions about the financial potential of joining a group, buying a practice, or managing an existing practice. We've covered common terms found in financial statements, identified key management reports, provided an illustration of the content and format for such statements, introduced and provided an opportunity to develop skill in ratio and trend analysis, and combined these concepts to evaluate the financial condition of a practice. While analysis of a practice's financial statements provides valuable information regarding its financial condition, we saw that it provides little information about the causes of that condition. We looked into two of the most important practice management systems reports to gain a more comprehensive understanding of the factors contributing to a group's financial condition. Career Physician offers additional resources to build knowledge and skill in assessing a practice's operational condition. Expanding your knowledge and skill in assessing the financial condition of a practice and its underlying operational drivers increases your ability to confidently make decisions regarding a practice and your career.